Hey, hi, this is Gautam. Welcome back. So in this video, we would be estimating equity risk premium. We would be looking at two approaches, you know, uh, uh, to estimate equity risk premium. And in the next video, we would be estimating beta. Okay. So once you've estimated beta and once we're done with the equity risk premium, then we would be able to estimate the overall cost of equity. Okay. All right. So now allow me to open up a whiteboard before we dive into the spreadsheet. Okay. All right. Okay. So last video, if you remember, and please watch that. Okay. If in case you haven't. So last video, we understood the concept of cost of equity and all the terms that make it up. Like cost of equity is the risk-free rate. Risk-free rate, by the way, is also called RF. Plus beta times equity risk premium. Okay, so we understood all these concepts in the last video. Okay, I'm just going to build up from where we left. Okay, in the last video. All right. So equity risk premium, again, why it's called premium? Because if investors, they're coming to the equity markets, they're expecting a premium, they're expecting a higher return, okay, an additional return over and above the risk-free rate. Because risk-free rate, they know, वो तो बना ही लेंगे by investing in government bonds. Okay, but they're coming to the equity markets because they are expecting a higher return, they're expecting a premium. Okay, all right. So equity risk premium, there are two, in fact, there are three approaches, but so we'll talk about the third approach as well. But in this video, I'm going to cover two. So the first approach, which is used by 90% of the institutions out there, that's the historical approach. Okay, so historical approach means you go back in time. You go back in time, okay, and pull the returns of the market, say of Sensex. Okay, from that return of the market, you net off historical return, you net off the current risk-free rate. Let's say, and by the way, how far back in time you need to go, how far back in history? See, that is different firms follow different things. Some go 10 years back in time, some go 20 years back in time. All right. So let us go 10 years back in time, but don't go like 5 years back because 5 years is not a huge time span. Okay? So let's go 5 years back in time, 10 years sorry back in time. तो RM, how do we RM कैसे estimate करेंगे? No, compute कैसे करेंगे? How do we compute RM of historical? Okay, so there are three things. Okay? One is the Sensex appreciation. Okay, okay, let's say the appreciation over the last 10 years is 13%. CAGR. Okay, then you have dividend yield. Let's say the dividend yield is 1.5%. Dividend yield, because there will be some companies which would give dividend. So dividend yield is basically if a company gives dividend, say TCS gives dividend, okay? So whatever dividend they give, that divided by their market capitalization is dividend yield for TCS. So similarly, dividend yield for the index is computed as well, and it's available there in the Sensex website. So we'll pull dividend yield from there. We don't have to like estimate dividend yield ourselves. I'm just we'll just pull it from the Sensex BSE India website. Okay, and then there is buyback yield as well. So a lot of companies they give buyback. So that is on another form of returning cash to investors. Okay, so buyback yield you would not really. It's hard to get buyback yield. Okay, unless you have access to a database. Otherwise, you would have to estimate it. Okay, so I have estimated it for Sensex for the last 10 years. So it's I would not say it's a tedious process, but it does take like a few, some time. So I would just show you as to how I've estimated buyback yield. Okay. So the overall return from the market based upon whatever assumption that numbers we have taken is 14.5 15%, right? So that's the historical return. So this is the historical return, 15%. From that, you net off the current risk-free rate. Let's say the current risk-free rate right now, the Indian government bond is trading is 7.2%. Okay. So this is 7.2%. Okay. So 15%. So 15.2% may you net off. Sorry, I'm just running short of space. So 15% may you net off 7.2%. Sorry, 7.2. How much do you get? Okay. You get 7.8%. Right? Yes. Okay. So until now, what we have seen is we have seen the historical method of estimating ERP, equity risk premium. And give you a quick recap, it was first you compute the return of the index or return of the market. Okay. And return of the market, how you would compute? You would have to go and pull out the stock price or stock or the stock index appreciation over the last 10 years or 20 years, depending upon how far back in time you want to go. Okay. All right. You pull out the stock index appreciation and add two things. You also add the dividend yield over that 10 or 20-year period and also the buyback yield. That's how you get the return of the market. Okay. And we'll compute this return of the market. Okay. And so you would get to know where do you need to go to pull this information from. All right. And then from the rest of the market, return of the market, sorry, you net off RF, which is the risk-free rate. Okay. Which is the risk-free rate. So risk-free rate, okay, is considered to be the 10-year government bond yield for a given country. All right. Okay. Now let's look at another method to estimate equity risk premium. In fact, there are two more methods, okay, but let's talk about one of them. And I have learned about them from Professor Damodaran. And it's my dream to meet him someday. By the way, I don't live very far from him by Houston, so hopefully that wish comes true some point in time. All right, so let's get back to this country rating based equity risk premium estimation. Okay, so now think from a perspective of an international investor. Say you are an international investor, you are based in the US. Okay, you invest in the US equity market. Okay, and in the US, let's say the equity risk premium, I think there's something wrong with my pen. And in the US, the equity risk premium, let's say, is 4.5%. Okay. But say if you want to invest in an emerging market like India, okay, you would be expecting a higher return because Indian market is perceived to be more risky than the US. Okay. So international investor is going to expect a higher return, an additional return over and above the return they would make in the US. Okay. So how do you compute that? How do you compute that additional return for the Indian market over and above the mature market premium? Okay. So for that, let's understand at a high level the concept of these credit ratings. All right. So most of the countries in the world, they're assigned a credit rating. Okay. Think of these credit ratings as the credit score that you and I have. Okay. So in India, you would have a CIBIL score, you would have a credit score. Okay. So lenders would, when you go for a loan, bank or a lender would pull up your credit rating or credit score or CIBIL score and then make a judgment what kind of loan they should give you. They would determine based upon your CIBIL score the likelihood that you would pay back the lender. Okay. All right. What's the probability of your default? Okay. And what is the interest rate that you should be charged? All right. If you have a low credit score, then you may not even get the loan. Okay. So similarly, okay, most of these countries are assigned a credit rating. Okay. So US has a credit rating of AAA, which is the highest rating there could be. So AAA means there is no probability of default. So if US issues a bond, they'll honor the bond. they'll pay back the bond holder. Okay. Let's Latin American country, there's a Latin American country, Argentina. Okay, so Argentina has a lower rating. I don't recall what the exact rating it has. Okay, so but many a times what Argentina has done in the past and many other countries as well. Okay, so if Argentina, let's say if they issue a bond, okay, and let's say if they are running short of money, okay, what they would do is they have two options: either to print more money in their country to pay back the bondholders, all right, or default. Because if they print more money, then the inflation in the country would increase. So they said, all right, let's default, and they have done that in the past. Okay, so there is a probability of default. There is a credit risk which is embedded in their government bonds. All right. Okay. So India ka rating, I think it's BAA3. Okay. This is for India. All right. So if you draw on that CIBIL score wala analogy to these credit ratings for these countries. So in India, the CIBIL score rate for any individual like you and me ranges from 300 to 900, if I'm not wrong. Okay. This AAA, think of this as a perfect score of 900. And think of BA3, let's say, as a score of 700. This is just to make you understand. Okay. All right. All right. So, say if an investor invests in the US bond market, okay, let's say they get an interest rate of, let's say 4%, or let's say 4% in the bond market I'm talking about. Okay, bond market. Okay, they get an interest rate of 4%. And if they invest in India bond market, okay, they'll expect a higher return because Indian market is risky. It doesn't have the perfect CIBIL score. There is a small probability of default which is embedded. Okay, so for Indian market, they may expect a higher, let's say 2% more return. So total return from the bond market, they may expect a 6%. These numbers I'm just using to make you guys understand. These are not the actual numbers. Okay, so this 2%, think of this as the spread from the mature market, US market ka return. All right. Okay. It is also, it's actually called the credit default spread. Okay. This is what it is called. Okay. All right. So this is for the bond market. All right. Now let's use this to compute the equity risk premium for the Indian market. So we were talking about the bond market. Okay. So let's come here. Abhi tak you were talking about the bond market. Okay. So bond market, the default spread, whatever default spread is based upon the rating. Okay. Ye rating se, this comes from the country rating. Okay. Default spread. This is for the bond market. Okay. But what we are computing is the equity risk premium, equity, not the bond market. So what you have to do is this default spread for the bond market, you need to scale it. You need to come up with something to convert it to the equity market spread or equity market premium. Okay. So this credit default spread of the bond market for India is multiplied by the standard deviation of the Indian stock market divided by the standard deviation of the Indian bond market. Okay, you can compute that. Okay, all right. But if you want to make your life easier, what you do is you go to Professor Damodaran's website and I'll show it to you. kahan se you can pull this in Professor Damodaran website. It's not, this information is not difficult to find. Okay. In fact, he selflessly makes everything available to us. Okay. So from Professor Damodaran website, we can look at what is India ka, the India ka based upon India ka rating. It will give us a default spread. Okay. And he also, Professor Damodaran also provides us the standard deviation of the emerging market as a whole. Not for India, but emerging market as a whole. So we can use that as a substitute. Okay. The standard deviation of the stock market for emerging markets divided by standard deviation of the bond market for the emerging market as a whole. So you can compute so these two parameters combined would give you the equity risk premium for the Indian market or any other market for that matter. Okay, jiska bhi you are taking the default spread. All right. So hope this was clear, and we look at both these two methods. Okay, we'll compute the equity risk premium now, both using historical method and then using credit rating method. All right. Okay. So let's do that now. Right. So let's start pulling all this information. Let's see, where do we pull all this information from? We've already looked at these concepts. Okay. So the exercise is estimating discount rate. So let's make some space in our spreadsheet. Okay. Because discount rate is what we're going to estimate. In our case, discount rate is cost of equity. All right. So the first thing that we're going to estimate is equity risk premium. So let's, in this tab, let's calculate equity risk premium. Okay. And give it a higher size. Okay. So the first method, so we looked at two methods, historical method and the country rating based method of estimating equity risk premium. So first, let's use the historical method, okay, and see where do you pull all this information. Okay. So for the historical method, you need the market returns for the last 10 or 20 years. For the market return, you need three parameters. Okay. One is so let's take Sensex as our index. Sensex is our market, Sensex return or Sensex appreciation. And let's go 10 years back in time. All right. And then we need the dividend yield as well. For the dividend yield as well, you need to go 10 years back in time. And then the buyback yield. All right. So the total of all these three returns, okay, would be your total market return. Let's designate it as RM. Okay. So this is what we need to get to. Right. Once you've got that, then we need risk-free rate as well, which is designated, which we are calling it as RF. Okay. All right. In fact, let me put it here itself. Okay. All right. So equity risk premium would be your RM minus R. That's the premium that you make over your risk-free rate. Okay. All right. So let's first, the total market return, let's see where do you get the Sensex return. Okay. So go to BSE India, bseindia.com. Here, click on S&P BSE Sensex. Here, then go to historical values. Okay. Select S&P BSE Sensex as the index. Select yearly because you need the yearly returns. Okay. The annual returns. Okay. Then go 10 years back in time. Okay, click submit. Okay, you get all these returns. Copy them, okay, and paste them in the spreadsheet. Let's create a separate tab. Call it Sensex data, and we'll house all this Sensex data over there. Okay. All right. Now let's tabulate the market Sensex return. All right. Okay. So 2013 would be a base year. Okay. Right. So, and then we'll go up till 2023. So it's totally 11 years, because for 10-year return, you need to go back 11 years, right? Yeah. So 2014, it's just been like in this calendar year, it's just been a month. All right. So I would just go up till 2023. Okay. If the approximation chalega. So here, let's calculate the annual return. Okay. How do you calculate the annual return? The close, the index closing price as of 2023 divided by the closing index as of 2022. Okay. All right. -1. This gives you the annual return. Okay. Now drag it 10 places up. Okay. And then select percentage. You get the annual return for 10 years. Okay. Here, type annual average annual return. Take the average, all these 10 returns. So this 13.59 is our average annual return. You could even take the compounded annual growth rate as well. Okay. So if you want to take that, what you need to do is take the closing index as of 2023 divided by closing index as of 2013. Okay. Caret 1 by 10, because it's 10 years compounding. Okay. So this is your return, 13.06. Okay. You can take either of these. Okay. If you take, say, average annual return, okay, then even for your dividends, you got to take the average annual dividend yield. But if you decide to take CAGR for your Sensex return, okay, then even for dividends, you have to take the compounded annual growth rate. Okay, so just please remember that. Okay, all right. So now let's estimate so we have the average annual return. So let's pull this first. Okay, so we have the Sensex return or Sensex appreciation for the last 10 years. Okay, so let's pull it. Let's take the average annual return, 13.59. Okay, and let's also write, it's always a good practice to key in the source. Okay. Now let's estimate the dividend yield or pull the dividend yield for Sensex. Okay, type Sensex key stat. Click here, index turnover. All right. Again, so you have dividend yields here on the right. Go up till 2013, 2014. Copy this and paste it in the Sensex data sheet. Okay. All right. Here, ten years, right? Yes. Okay. So here, so you have the dividend yields here. Okay. All right. See, 1.22 is actually 1.22%. Okay. So you got to append uh, the percent sign after 1.22. All right. That's how you should read it. Okay. So the average dividend yield, okay, for the last 10 years is average of, start from here and go up till here. So 10. It's 1.204. Now let's convert it into percentage. Okay. Click here and then, so we clicked here, percent sign, and then let's divide by 100. Simple. Okay. So we have the average dividend yield for the last 10 years estimated as well. Now let's plug this here, the dividend yield. So we pulled it from here. So this is 10-year average. So let's write it. 10-year average. Yeah. The source again is same source, BSE India. All right. Now let's now dividend buyback yield. See, buyback yield is not easily available. Okay. It's so you have to compute the buyback yield. You will have to look at 3-4 different places and then compute the buyback yield. Unless you have access to database, then great. Else it requires some work. Okay. So in this video, I would briefly walk you through how do you estimate the buyback yield, because I've already done that. I'll just walk you through what I have done. Okay. I'll make a separate video on buyback yield, which would not be part of this series per se. It would be a separate video. Okay. And it would be a long video in which I would estimate it in front of you. Okay. Just like I estimate Sensex return and dividend yield, but these were like straightforward. All right. So let me, without further ado, let me pull, because I've already estimated buyback yield. Let me just pull it. And walk you through how I have done. I've pulled this information at a high level. Okay. All right. Okay. All right. So one thing, okay, one thing more. So let me see, first you need to find out which companies did the buyback. Not all the companies do buyback, just like not all the companies do dividends. Not all the companies return cash in the form of buybacks. Okay. Last year, that is in the year 2023, only 3 companies in our index, the BSE 30, because see, BSE Sensex is an index of 30 companies. Okay. Of those 30 companies, only these 3 companies announced buyback. Okay. How I came to know that information, let me show you that as well. Okay. I think that's important. At least give you guys something. Go to Equity Master. In Equity Master, go to research it. In research it, go to buyback. Here, select index. You select BSE Sensex. 2013 is already selected. Hit go. You see the same 3 companies pop up: TCS, L&T, and Wipro. Okay. Let's see. Right now we are on the 3rd of Feb. Okay. Let's see if in 2024, in the last 1 month, any company came up with a buyback. No company came up with a buyback. So we have only 3 companies that came up with a buyback. Okay. TCS, L&T, and Wipro. So these should be considered in our buyback calculation for this year, FY24. Okay. All right. So now let me go to the buyback yield sheet. Okay. So what you do is, and again, walking you through this process at a high level, just so that you kind of understand the concept. Okay. And you can do it on your own. Okay. It's not like difficult or something. Straightforward. It's just that it takes some time. Okay, it's not as straightforward as pulling the Sensex return or dividend yield. Okay, so for TCS, you just Google. You would come to know that TCS announced a buyback of 70,000 CR. See, not all the buybacks are accepted 100%. There is an acceptance ratio. So you find out the acceptance ratio, you multiply the acceptance ratio or acceptance percent with the buyback, then you get to know the actual buyback which took place. Okay, and then all right, you have to you look at the number of shares of that company and the share price of that company at the beginning. When I say at the beginning, what I mean is, see, usually buybacks, they happen over a period of time. Let's say the buyback started say in December 17th and they ended on December 14th. Okay, so December 7th, I'm just making it up, these dates. So December 7th, you got to pull the share price, okay, and multiply it with the number of shares and get to the market cap. Or, if you have the market cap at the beginning of the period, then obviously you don't have to do this multiplication, just plug in the market cap. All right. So once you have the market cap, you can estimate the buyback yield. Okay. Just actual buyback divided by market cap would give you the buyback yield. Do that for all the companies. Okay. Once you're done, okay. All right. Once you're done computing the buyback yield of all the three companies, there are two additional steps that you need to do to estimate the overall Sensex buyback yield. What you need, two steps. First step is, okay, total up all the buyback dollars, all the buyback rupees, okay, divide the actual buyback with the total market cap of all these three companies put together. Okay, all right, you would get 1.89 buyback divided by total market cap, 1.89. Now the second step that you need to do is, okay, you need to multiply this 1.89 with the weight of all these three companies put together in the index. How do you get the weight? Okay, so again, go to equity master. In equity master, go to today's market, click on list of BSE 30 stocks. Okay, if you see all these 30 companies will be pulled up, look at say L&T or TCS. Yeah, TCS. Okay, you see the weightage here. Sorry, you see weightage here 4.7. Yeah, pull this information and plug it in here. Okay, obviously the weightages, they keep on changing from time to time. When I did this, it was 4.6%. Okay, right now it's 4.7%. So ideally, the weightages should be pulled from the beginning of the period. Okay, all right. Okay, so any which ways, the total weight of all these three companies is 11.3. You multiply this 11.3 by 1.89, okay, which is the buyback yield of these three companies put together, multiplied with the weightage of these three companies in the index. Okay, you get 0.21. Okay, all right. You have 0.21. Okay, all right. Now this 0.21 is the buyback yield for this financial year. Ideally, you should have to do the same process the last, not only, you have to go back like 9 years back in time, 10 years back in time, do this for all the 10 years and not just for 1 year. Can then compute the average. Okay, all right. But I'm making an assumption. Right now, I'm making an assumption, okay, that my average buyback yield is the same across all these years. That's the assumption I'm making. Any which ways, this is a small, I don't think it's going to like impact our discount rate a whole lot. It's a small number. Okay, but this is essentially the process. And as I said, I'll make a separate video, not as a part of this series. It's part of a different series in which I'll do this estimation, with you. All right. Okay. All right. The source of this, let's say, is Equity Master. And this is 1 year, and we have assumed that this is for the last 10 years. All right. So now we have the total market return, which is like the summation of all these three parameters: Sensex appreciation, dividend yield, and buyback yield, which is 15.01%. All right. What about the risk-free rate? Risk-free rate we are taking as a 10-year government bond yield. Okay, so risk-free rate is 10-year government bond yield. ठीक है, ये हम ले रहे हैं 10-year government bond yield. Now let's Google कि इंडिया में क्या 10-year government bond yield अभी कितना है. Yeah, click on investing.com. A lot of websites would tell you this information. It keeps on changing all the time. So right now, as of I'm recording this video on 3rd of Feb. So close of market on 2nd of Feb was 7.05%. All right. So let's plug this information. 7.05%. All right. Okay. Now ERP is simple, no? You take the total market return minus your RF. This is a premium. See what happens. RM minus RF. Okay. And yeah, by the way, write the source here as well. Source is okay. All right. So this is your ERP that you've estimated through the historical method, right? All right. All right. Okay. Now let's look at another method, which we've discussed already, which is the country rating based method. And as I said, I've learned this from Professor Damodaran. So full credits to him. Country rating method. What you need to do is, okay, first you need the equity risk premium for the US market. Okay. Then the other piece of information that you need is the credit default spread in the Indian market. Okay. And then you need the standard deviation of the stock market. Okay. And standard deviation of the bond market. Yeah, you can go back and look at the formula, right? It's equity risk premium of the mature market US. Okay. So think of from a perspective of an international investor, if they are in the US, okay, and if they are investing, they want to invest in India. Okay, so they obviously India is perceived to be a risky country, so they expect an additional return over and above the premium that they'll make in the US. How do we get this information? It's pretty simple. You know, it's very simple. Professor Damodaran does all the hard work for us. Okay. So go here, type country default spread. Yeah, let's type that. Country default spread based upon Moody's rating. Okay. Click on this NY Stern website. Okay. First, here you have the equity risk premium of all the countries. So basically, he's already done that using this method. Okay. So first, let's pull the, let's go in, let's look where India is. All right. It's 2.39 is the credit default spread for India. So let's put that information here. And India का rating क्या है? India का rating is BAA3 based on BAA3 rating. Okay, all right. And the source is Professor Damodaran. Okay, all right. Now, what about equity risk premium for the US market? Okay, let's type United States. Okay. So if you see, by the way, if you see the credit, the default spread for the US is 0.00 because it's AAA, right? That's what we had talked about a while back. The US market doesn't have any default spread. It's not perceived to be risky. Okay. So the equity risk premium for the US, which is the mature market, is 4.6. So let's pull that information. Okay. And now what we need is these two. Hey, hi. So I have to reshoot this portion. I'm reshooting this portion of the video because last week when I checked, I realized that this last portion of the video did not really get recorded. So I'm compelled to reshoot. All right. So what we need to do is we need to estimate the standard deviation of the stock market and the standard deviation of the bond market for India. Okay. So what are we trying to do here? Okay. So we're really trying to gauge or estimate how the stock market has moved in relation to the bond market, let's say over the last 10 years. You can even go back 5 years, but since for the first method, historical method, we went 10 years back in time. So even for this method, let's go 10 years back in time. All right. So now restating. So we need to gauge, we need to estimate how the Indian stock market has moved over the last 10 years in relation to the bond market. That is what we want to get at. Okay. So there are two ways to get to this estimation. One is, okay, just go to Professor Damodaran's website. What Professor Damodaran does is he estimates the standard deviation of the stocks of the emerging market, okay, and the standard deviation of the bonds of the emerging market. He doesn't do it for India alone. He does it for the entire emerging market universe. Okay. So if you want, you can just pull that information. I'll show you where he houses that information. See, but the only problem with pulling those data points is that, as I said, it's for emerging markets, the entire emerging market universe, and not for India alone. Okay, but here we are doing all these estimates for India. Okay, and India operates differently from other emerging markets. Okay, all right. So what I do is I estimate this information for India. Okay, and there is a very easy way to do this. Okay, you can estimate standard deviations of both stocks and bonds, but the easier method really is okay, you go to BSE India. Okay, I'm just checking if I'm really getting recorded. Hopefully I am. Okay, then go to S&P BSE Sensex, click historical values. Here, click S&P BSE Sensex. I just want to make sure that I am indeed getting recorded. All right, all right. Okay. Then select daily. Go 10 years back in time. Okay. To today. Click submit. Okay. Capture the closing index price as on 10th Feb 2014, which was like 10 years back in time. Capture that information. Okay. Right. Sensex Recording in progress. As of 10/2. Okay. Then okay, so this is 2014. Then now we need this information for as of today. It's 10th of Feb 2024, like Saturday today, but any which ways. Okay. We don't have to worry about being precise with the dates, honestly. So let's go back. See, sorry. Let's let me select 2024. Okay, so this was the 71,595. 71,595 was the index price as of 9th of Feb closing. Okay, so let's capture that information as well. Okay, all right. Now, so how much has the Sensex moved over the last 10 years? Just divide this latest Sensex index closing price with the one which on 2014. Okay, so index over the last 10 years has moved 3.5 times. The 10-year. Okay, all right. Now let's do it for the bond market. You can see how much has the bond market moved in vis-a-vis the Sensex movement. Okay, so let's do it. So let me open up a new browser and type India bond index. Go to S&P BSE India bond index. Here, this chart opens up. Okay. Select 10 years. Okay. Pull the latest index price, which is as of 9th Feb, 229.29. So let's pull that information. Okay. So bond index as of 9/2/2024 is 229.29. All right. Now also let's go back 10 years back in time. Okay. And pull that same information. So almost 10 years back in time, the index was 100.10. Okay. Like, don't care about like absolute precision. Okay. So let's capture that information. So bond index as of 2014 was 100.10. In fact, that was the time when this index started. That's why it's near 100. Okay. So what's the bond movement? How has the bond moved? Or the bond return, you can call them. It's just that this is not in percentage terms. All right. So how does the bond move? It's bond index, latest bond index divided by bond index as of 2014. So it has moved around 2.29 times. All right. Okay. Let me align this as well. Okay. So now, what's the relative movement of Sensex vis-a-vis the bond market? It's 3.52 divided by 2.29. So what this information tells us is, okay, that the stock market has moved 1.5 times more with respect to the bond market. That's what this information is telling us. Okay, so let's use this information. Let me get rid of this. Okay, delete this. Okay, so equity risk premium is equity risk premium of the mature market plus 1.54, that's the relative movement in stocks, in Indian stocks vis-a-vis the Indian bond market, times the credit default spread in India. Okay. So you get 8.27 as the equity risk premium. You see that this is in a shouting distance of the equity risk premium that we've estimated using the historical method, although it's slightly more. Okay. All right. So let's try the sources. Okay. The source of this was Sensex was BSE India again. Okay. And bond movement again is for the last 10 years. Source for SP Global. Source for the bond index was spglobal.com. Okay. All right. So it's always a good practice to put in remarks and put in information about your sources. Okay. Now let's make this a little more professional. Okay. And let's do the same thing here as well. In fact, we should have done this earlier. All right. Now, okay. Now let's pull a similar set of data points from Professor Damodaran's website. Okay. And let's see what equity risk premium we land at. All right. So just making sure that I'm getting recorded. All right. Okay. So now let's open up a new tab and let's type standard deviation. Yes, let's do that. Okay. So here, click on the first link. Go to January 1, 2024 update. Okay. So an Excel file has been downloaded. Okay. So let's open that up. I have the file already open, so I'll go there. Let me pull that up. Okay, all right, just let me pull this up. Okay, here. So what Professor Damodaran has done is he has looked at two indices. One is he has looked at the JP Morgan USD Emerging Market Bond ETF. Okay, and he's pulled the standard deviation. Okay, he has gone 5 years back in time. Okay, and from this emerging market bond ETF, he has computed the standard deviation for each of those 5 years for the bond market. And then he's pulled up the S&P Emerging Stock Market Index as well and done the same thing. He's gone back 5 years. For each of those years, he has pulled the standard deviation for each of those years. And then he's taken the average standard deviation. Okay. So standard deviation of the stocks in the emerging markets, and not just one emerging market, but the entire emerging universe, that is divided by standard deviation of the emerging bond market, which is 11.58, and he's arrived at 1.34. So if you want, you can straight away pull this number as well. But again, okay, this number is not for India alone. The risk of repeating myself, this is for the entire emerging market universe. Okay. All right. So let's go back to our sheet. Okay. So let's see if we use this number, relative volatility, which is 1.34. This is the number from Professor Damodaran. Source is Professor Damodaran, and this is for the emerging markets. This is for emerging markets. All right. So the equity risk premium that we'll arrive at is equity risk premium US plus this relative volatility times the credit default spread. Okay, so the equity risk premium that we've arrived at is 7.8. And let's just write that this is using EM relative volatility. Volatility. My gosh, what's the spelling? All right, okay. Yeah. All right. See, so you would see now we have 3 equity risk premiums. All right. So which one should we go ahead with? Okay. So we have 2 equity risk premiums that we've obtained using country risk rating method, and we have one from the historical method. Okay. The one we did estimated just now using the equity emerging markets relative volatility, okay, is also pretty close with the historical method. In fact, it's a notch lower. Okay. So see, I would use this historical method equity risk premium, okay, simply because it's it's used by 90% of the institutions. It doesn't make it the most robust method, but it's used by 90% of the institutions out there. Okay. And in using this, the trade-off that I'm making is that this is this is not forward-looking, this is historical. Okay. In fact, the credit rating method, uh, these methods, the credit rating method is also historical, it's not forward-looking. Okay. There is a forward-looking method as well, but let's discuss it later. All right. For now, for our intent and purposes, we'll use this equity risk premium for now. Okay. But I'm hoping that you guys understood the country rating method of equity risk premium derivation as well. Okay. All right. Okay. So that this is it for this module. In the next sub module, we look at calculation of beta. Beta, I've already provided you, explained you the concept of beta in the last module. Okay. So once you're done with the beta calculation as well, which is the next sub module, we will be able to estimate cost of equity. Okay. So that would complete our discount rate, calculation. And then then we can get on to valuing this business. Okay. Because we'll have the discount rate. All we need to do is we need to estimate the free cash flow and then discount them to the present using the discount rate that we'll estimate. All right. So, all right. So if you guys have any questions, feel free to write to me.